Hello everyone, here at Chris Capre, SecondSkiesForex.com. Philip J, hello. Phil Hytham. Sound is okay. Good to hear. Small group today and understandable. I was scheduled to do my webinar yesterday, but they seem to be having issues with here in Argentina, the internet provider I had was working on putting in some new cable and things like that, some new lines. So I'm not sure if it's actually helped. But things were down yesterday, so my apologies on that. And it's ironic here today, too, because we're only at about like 55 degrees weather, but because the sun is just blasting on my office here, because my office faces east, the sun is blasting on me, it feels like it's 90 degrees in here. It's just ridiculous. So I actually have the air conditioning going on inside, even though it's only 55 degrees outside. Anyway, so with that being said, welcome to today's class on price action trading. And who here was in my class last week? Just out of curiosity. And also, while I'm asking that question, who here is here for the first time? I wouldn't be surprised if we get some first-timers just because the day is different. And sometimes people have schedules that force them to not be there on Tuesdays. So who is here for the first time, and who was here last week's class? Anyone? Nobody at all? Are you guys shy? Normally you guys aren't so shy. Sissy Banana was here last week. Okay, fantastic. Are you the only one? That can't be. Dan is a newbie. Okay, welcome, Dan J. There had to have been somebody else here that was there last week. Nobody? I would be shocked. Nobody wants to confess. Fair enough. Blakey was most. Okay. Well, since Sissy Banana was the only one that seems to have been there last week, which is weird because we had like 70 plus people in there. Do you remember what were the three instruments I said I was long on? Keep in mind, last week's class was on a Tuesday, so that would have been the 24th. But who remembers the three currencies that I was long on? You might remember, Boyke. You were there, I think. Do you remember Sissy Banana or Boyke? Wow, you guys are being bashful today. It's not helping either. It's not helping because we're recording this class. We were supposed to record it yesterday, but today we're recording it. Wow, you don't remember. Okay. Well, then let's just go ahead and skip that. So, actually, I want to talk about a couple things. I want to talk about a brief structural thing that I'm seeing in the Aussie dollar and where I think it's likely going to go. And then I want to talk about what I think is one of the more interesting pairs. Believe it or not, I actually have been looking at the markets very heavily, and there are only a few instruments that I'm really interested in trading right now. You know, sometimes there just happens to be a lot of really hot trades, and it could be because of a black swan, or it could be because of anything, but you know, sometimes there are times in the market where there's a lot of really hot trades. Consequently, there are going to be times where there aren't as many hot trades. And one of the things that traders tend to fall into is kind of a trap. And I understand this trap because I've gone through it for years. You know, I've been doing this for about 10 years now, and I really understand a lot of the traps that traders tend to do. And you know, and I've learned to avoid them consistently more and more as time goes on. And one of those is that when the markets aren't necessarily primed for a lot of trading, traders still tend to trade just as frequent as if there was a lot of good trades. And it's partially because of boredom. It's partially because You want to make money. Most people I know don't have all the money that they want, or that they at least need. Most people don't. There was a study in America that something like 76% of all Americans could not come up with $2,000 cash if they needed it. And that's not good, we're supposed to be one of the larger economically, abundant countries out there, and that's not good at all. That 76% of Americans could not come up with $2,000, just liquid cash to provide for anything. And so, as a whole, across the world, we're seeing generally, other than a few of the emerging markets, the BRIC countries, we're seeing the disparities between the wealthy and the poor become further and further exaggerated. And so what that means is just most people don't have the money that they need. So if somebody sees movement in currency, it's very common for beginning traders to make the mistake that because there's movements, that there's an opportunity to make money. And in some sense, on a base level, it's totally true. If there is movement, there is opportunity to make money. The problem is that the part where it's kind of not true is that just because the markets are moving doesn't mean it's a really good environment to be trading very actively. And so kind of like, and sometimes I hate comparing it, but kind of like in Vegas, there are actually some days that you're more likely to get payouts and do better and make your winnings than others. Especially if you're a slot player, which to me I think is completely ridiculous. But let's say you play slots. There are actually days where slots are going to do better than worse. And part of that has to do with the kind of marketing behind slots, in the sense they want it to be more active in the higher active times so that it creates a buzz. People feel that buzz and they gamble more and things like that. So what makes me look at these markets and say that there aren't as many opportunities? Well, it's actually just the pure price action, which is what this class is about. This class is about learning how to read and trade price action. And from what I'm seeing in a lot of the currency pairs, I see less opportunities just for a short period of time, and then I think things are going to open up. The valves are going to open up a little bit. But what I'm seeing is I'm not seeing a whole lot of pairs that are massively trending. I'm seeing a lot of pairs in what I would call in-between zones. And I'm seeing a lot of price action on both sides of the market. And that is really kind of creating an environment where you don't want to be involved as much, and you want to be much more selective. In terms of being more selective, where would I say the better opportunities are? I think from a price action standpoint, the best opportunities right now would lie within the euro, would lie within the Aussie dollar, and then we'll talk about my hottest, what I think is probably the hottest currency pair to trade right now out there, because it's at such a critical juncture in terms of its history, in terms of price action, in terms of where it's at. So first I want to talk about a structure that I'm seeing in Aussie dollar, and this is a structure that you're going to want to learn to kind of remember. It is very common that after trends that the market will, after a long extended move, the market will pull back, but it will pull back in a way that is what we would call structured and orderly, and it's not super impulsive. It's more corrective in nature. Does anybody here, or does everybody here understand when I'm talking about impulsive versus corrective moves, what I'm referring to? Yes, no? Who here feels like they do understand it, and who here feels like they do not understand? Okay, so far we got two. Philip does, Linda does, Chelsea, Swerve to Plumber, fantastic. You mean retracement? No, I'm not talking retracement. I'm just talking impulsive versus corrective moves. They're not necessarily equal. Okay, so it seems like everybody here does. If anybody doesn't, please let me know. I'd be happy to explain it briefly. It's important that everybody understands it. But with that being said, so as I've been saying for weeks and weeks and weeks now, this is a traditional price action formation. It is critical that you understand this, that you drill this in your head, and that you learn to really use this as like one of your core principles in trading. Impulsive moves tend to be followed by corrective moves about 75% of the time. What usually happens from there is that after the corrective move, the next impulsive move is usually in the same direction as the original impulsive move. So if the first impulsive move was up, then the next impulsive move that usually continues from there is also going to be up. And this pattern tends to continue until an impulsive move is met by a counter-trend impulsive move. Now, one of the things that I've been talking about for a long time is that I don't just look at price action in the sense of, I don't just read it from the traditional definition. The traditional definition of price action is prices movement over time. It's a very simple definition. And most often when you find price action traders out there, price action students or teachers or mentors, they're traditionally just talking about structure. You know, what is the physical structure of these movements? And in the beginning, patterns were very basic. You know, they were like, you know, 8th grade geometry patterns. They were triangles and wedges and, you know, and pennants and all these things. They were very basic, but the bottom line is the market's evolved, and price action as a field has actually gotten a lot more advanced. And so these formations are starting to get more advanced, but the bottom line is the structure, that physical structure or physical appearance, is what most people talk about when they're talking about price action and study it. To me, that's just one element of the game. And when I'm talking about price action, I'm always doing it with the intention of understanding the order flow behind it. In other words, what were the buying and selling orders or environments that could have produced this particular type of price action? When you can learn to extract what kind of order flow environments would have created that price action, then you will have a significant edge in your trading, because you'll be understanding what are the dominant forces in the market at that time and where you want to be moving with that. If the waves are breaking south, you want to be trading with that there. If the waves are breaking north, you want to be trading with that there. So it's very important that you understand how to read that. And learning how to read impulsive versus corrective does help give you that possibility. It's one of the core things in reading price action. But, again, getting to the point, which is that why is it typical that 75% of the time an impulsive move is followed by a corrective move? Well, the bottom line is that for people to make money, it generally helps if the market is moving in more in one direction than the other. And that usually means that the market has more of an opinion on one side of the market than the other. So in this case, Aussie dollar, since mid-March, has been trending quite nicely. 1,300 pips, nice little run in about a month and a half. The market was obviously biased to the long side, so the order flow was more skewed to that side. Now, a corrective move has since followed, and this is a very common structure that I want you to remember. It's very common that in trends, the market will pull back, and as long as the pullback is not super aggressive or super dominant or overwhelming, then the market will often continue in that same direction as it was before. And that's kind of what we're seeing here with this move here. This is what we would call a very structured or orderly pullback. What are some of the elements of it that kind of tell me that this corrective move is not as powerful as the impulsive move? Well, one of those, and this is something I've been talking about for weeks now, is the angle of the move. This generally plots the angle of the price action acceleration on the long side here. And we can plot it, the sell-off here, as kind of more of a base angle like this. Now this angle is much more base than this one is. This one's much sharper. And the only way you can create sharp price action angles is if you have faster acceleration of buying and more participants in the market. And so the angles confirm that the overall bias is still more to the upside because the nature of the selling is rather base and corrective. The other thing about it that's very common in corrective sell-offs instead of impulsive sell-offs is that there's kind of a push and pull, a tug and war, and it tends to be somewhat orderly. And that's what we're seeing here. After the first initial rejection off 110, look what happens with the price action here. We have the up, down, up, down, up, down. And that is a very common sign that the buyers are still involved in the market. In this series of price action, the sellers aren't involved in the market. And if they are, it's almost non-existent. Even though the market is declining, we have hints that the buyers are still actively involved. And with that being said, that's why we have this kind of corrective, orderly pullback. So anytime I usually see these environments where something's been trending for a long period of time, and then it runs into an orderly correction, it usually signifies that the trend is going to resume at least to the point where the market's going to try and make an attack on the recent highs of the trend. I am suspecting that is the case for the Aussie US dollar. When we drill down, not just because of the structure here, but when we drill down even to a lower time frame, and we zoom out just a little bit, we can see more of that corrective nature highlighted here. Now, remember how I talked about that impulsive moves will continue in the same direction? Impulsive moves are generally followed by corrective moves, which will genuinely continually be followed by impulsive moves in the same direction until they are countered by another impulsive move in the opposite direction. Well, as the sell-offs start to happen on a more microstructure, we can see the impulsive move was to the downside. This was decent. This was pretty strong here. But then what happened when followed was another impulsive move to the downside, followed by a corrective move, followed by an impulsive move, followed by a corrective move, more of a base angle, followed by an impulsive move, followed by a corrective move, followed by an impulsive move, followed by counter-trend impulsive move. Now, can anybody see, and I'm going to highlight these three moves here. This move right here, the first major sell-off, the second major sell-off, and the third one here. Can anybody spot anything in there that would have hinted that the market was looking to possibly reverse with the Aussie US dollar? Can anybody spot anything in there? Yes, Fernando did it. Fantastic. Well done. So, that was exactly the key point I was looking for. They keep getting smaller and smaller. And what does that generally translate into from an order flow standpoint? What it translates into, hold on one second, sorry about that. What it translates into is that if the sellers are dominant during these impulsive moves, but their moves are getting absorbed more and more, then their orders are getting absorbed on the buy side. So their offers continually keep getting absorbed more and more and more. They're running into people that are willing to push back upon that, and every time they push back, they're getting more and more confident, and they're absorbing the impact to the downside with greater force. And eventually, they will absorb it with enough force to where they will try and reverse the market. Does that all make sense of how that order flow works when the market starts to absorb orders and then reverse course? Does that all make sense? You can see it from the physical structure of each one is getting smaller and smaller, but that's generally what it translates into from an order flow standpoint. So does that make sense for everybody? Yes, no? Good, fantastic. It's important that you do understand what kind of order flow could create these environments. Once you start to do that, then you will really start to gain a significant edge in understanding what's happening in front of you in real time and how you can trade it. Absolutely critical. So we're starting to see that here. But the Aussie dollar still got some work to do. Even though it has taken out the recent highs, before it was making lower lows and lower highs, now it's making higher lows and higher highs. It's still got a little work to do. It's still got to take out this 61.8 here. Now, I think that if it can take out this 61.8, then I think there is a continuation move all the way up to this 108.75 region here, which offers about a 85 pip move. And from there, I think really you're going to this is kind of the last defense before we revisit this 110 mark over here. And if I'm correct, this thing hit 110 within a pip. Yeah, went a few pips past it, and that was it. So, with that being said, there could be a potential for this to make a nice run to the upside back to 110. It's just got to clear this 61.8 here, and then I think you got to take out this and you're on your way. So I think that's something you want to be watching in the near future. But the one that interests me the most out of all of them, and I'll show you why. This is what I think is the hottest pair and the one you want to be watching the most. New Zealand US dollar. Now, this is a daily chart over the last 3 years. As far as we can tell, this is as high as it's been. And it's at a very critical level right now. And it's when the market gets to critical levels that we should be most interested in trading these things. If you were to look at this here, it's a majority of blue candles in comparison to red, in particular to this year. It did start off initially selling, but then went on a massive run, brief, orderly, structured pullback, and then a new run taking out the previous highs. Now it seems to be stalling right at this current level, is 82 and a quarter here. So if you zoom back long enough and maybe go to a weekly chart, we can now see why. Because we're actually looking at the all-time highs for the New Zealand US dollar. It's sitting just above it as we speak. And this is very, very important. In fact, if we look at it, keep in mind around 82.12 was the previous all-time high. So we have just taken that out. And so now the question becomes, is it something that's going to reverse? If so, how much? Or is there some long opportunities here because we could be going into new territory for the pair? Well, when we zoom into a 4-hour chart here, this 82.11, which was the previous all-time highs, as the market has broken through it, is definitely getting tested. It was tested initially, market broke through it, pulling back to it, and based on this price action, the market seems a little indecisive to me. Not enough for me to want to make an order to go long on it yet. I would rather be long than short, and I'm definitely keeping an eye out for long opportunities on this, but the market doesn't seem totally decisive yet. Why do I say that? Let's zoom in. This is the most recent run here, which started May 17th, back at sub 7,800. So you're talking a good 450, 500 pips ago. This thing has basically held above the 20 MA quite consistently. And it's just been kind of gaining. We can see the curvature acceleration of price action until we hit the major ceiling, pull back a little bit, run right through it. But then take a look at this price action since then. This thing broke a total of 1, 2, 3, 4, 5, 6, 7, 8, 9. 9.5 candles ago. This is a 4-hour chart. So you're talking 36 plus hours ago, this thing broke through it. And it's not making massive new ground. In fact, it only made about 25 pips new ground. So what can we draw from this here? We can draw from this from an order flow standpoint that we haven't seen a whole rush of new technical buyers come into the market because the market isn't totally sure the New Zealand dollar is going to continue. If it was, and we did see a new influx of buyers without really any increase in sellers, then the market would just keep going. How do we know that? Because the market was already long as the thing was climbing. All the order flow was on the long side. But we're not seeing that right now. So the market is feeling really tentative with the New Zealand dollar. It has pulled back to this previous highs, which is now using it as support, and it continues to bounce off of this. But we're seeing a lot of wicks on the top side. In fact, more wicks on the top side than we are seeing on the bottom side, telling us that and communicating to us that there is selling interest in the New Zealand dollar right now. There are two sides of the market that are playing on each other, and nobody is dominant. If there was no selling interest coming into the market, then what we would be seeing is, we wouldn't be seeing a lot of those wicks and rejections on the top side. If it was just consolidating and some profit taking, then we wouldn't be seeing rejections. We would kind of be seeing the market move sideways without those wicks on the top side. It would kind of close at the top and then slowly drift back down. But the wicks communicate to us rejection in the sense that somebody is coming in as the market advances here, here, and here, that somebody's coming back in the market and pushing it back down, at least enough to keep it contained. So what we're seeing is that we're not seeing that huge influx of buyers yet. I think what we're seeing is the market's trying to kind of test the waters and say, hey, look, Kiwi dollars had an impressive run. Keep in mind, this run started way back the middle of March, way down here at 7,100. That's 1,100 pips ago. That's a big move for this pair. You're talking about, what, 15% move? That's a big adjustment. So the market is really saying, hey, we've had a big move. Do we really have the strength to keep on going? Now, before we get into that and start to address that question a little bit more and where I think it's going, let's ask one of these questions here. Fernando's saying, what would it take for you to pick a side? An impulsive breakout, maybe a retracement after that? It's a great question. There would be a couple things I'd like to see. One, I'd like to see, let's start with each side. What would I want to see to take a long position? Well, one thing that would make me feel more comfortable is the 20 MA drifting up here, because then that could be kind of an additional support that would prop this pair up. The other thing I would like to see is, I would like to see these blue candles start to outweigh the size and force of the red candles. Keep in mind, one red candle took over 1.5 candles buying. And we had 2 candles of buying, and then one red candle kind of took it out. 2 candles of buying, and one red candle kind of took it out. I would like to see that kind of relationship reverse to where one candle buys it up and launches it, say, 30 pips, and then the red candles, as they start to push back, are very timid in nature. That would be one thing I would like to see in addition to the 20 MA. I'd also like to see less rejections on the top side. I'd like to see it close towards that 82.50 and then slowly drift back to the 82.11. That would tell me that whatever sellers were coming in at 82.50 weren't really pushing back as hard on the market. What I would also like to see is this level definitely hold. I would not like to see any 4-hour closes below 82.11 or 8200 or the 20 MA. If I saw that, then I would say, whoa, I'm going to want to see something else before I consider buying. Because that would mean that whoever was propping that up at 82.11 is no longer doing that. So those are some things I'd want to see. And probably the last one I'd like to see is, I'd like to see a nice blue candle that closes above all these highs, because all these highs are really consistent, which to me communicates that there is a consistent force involved in smacking this back down at 82.50. I would like to see a nice blue candle kind of open up here, towards the highs, come back down, touch this, and then see a nice, strong rejection to the downside and have it close above all this. I think that would be a really good trigger to say, hey, the buyers have now come in force again. They rejected any downside movement, and they said, okay, we're not only going to reject this, but we're going to also make some new highs. So whoever was defending the 8250 level has been taken out. And I'd like to see it clear it by a good 10, 15 pips. Because if there's any stops, if there's any forces that are absorbing the offers at 8250 there, or absorbing the orders at 8250, they're probably not far beyond that, 10, maybe 15 pips. So I'd like to see the market advance beyond that, and then I would feel really good about it. So those are some things that I would like to see, at least on the buy side. Does that answer your question there, Fernando? And not just Fernando, does that make sense to everybody else as to why those would be very good things to see if you're looking to get long? Does that make sense to everybody? Boyke says, cool. Okay. All right, one person. So with that being said, let's talk about the other side of the market. And then we'll talk about where I see the Kiwi dollar going eventually. Carly says yes. Fantastic. Good to hear, Clay. Okay. Now, in terms of the sell side, what would I want to see to pick a side on to be on the bear side? I definitely wouldn't want to see any 4-hour closes. We can take some of the things that we want to see on the buy side, and then we can take the inverse of that. So I wouldn't want to see any 4-hour closes above 8250. In fact, I'd like to see a 4-hour close below 8211 and 8200. I'd also like to see a 4-hour close below the 20 MA. And then if the market started to kind of test the 20 MA and use it as resistance instead of support, that would be a very good sign as well. So to see that, that would be further confirmation that the relationship to the 20 MA has reversed. It's called a role reversal. I also would not want to see any blue candles that become more dominant than the red candles. And I would want to see a really good, market open here, come back up, test this, get a really strong rejection, and have the market close below all this. All of those would be really good confirmations that short term this market's going to pull back. Whoever was propping the pair up said, we're going to step out for a little bit. We're going to see how much this market pulls back. We're going to probably buy the Kiwi dollar cheaper and then get back in and make a new attack on the high. So that's what I would want to see in terms of the sell side. Take the things that we had in the buy side and just put the inverse to them, or apply the inverse. So that's what I would want to see. Now, in reality, do I think that one side is probably going to win out over the medium and long term? Yes, and I think that's going to be the upside. One, since this mid-March here, it's been dominantly blue candles. Since this last pullback here, we've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, not including today. So the last 12 days, this is a daily chart, out of the last 12 days, we've only had 2 days of selling. 10 out of 12. That's very strong, suggesting that the market is overwhelmingly on the long side on this one here. So, and I expect that will continue. If we look at it on a weekly time frame, we can see that 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, even 11, even this week. So the last 11 weeks, this thing has gained 9 out of 11 weeks. And I think the forces that have been pushing this thing up 9 for the last 11 weeks are still in play. I don't see that changing anytime soon. If we expand out a little bit further, we can see, and let's go even a little bit further, we can see that since we hit these all-time highs before, and the massive sell-off of 2008, the blues have been predominantly in control of the market. Remember how I talked about that Aussie dollar and that corrective, structured, orderly pullback? Same structure is here. And it started a new run. Same thing here. Kind of orderly, has a nice rejection to the downside, starts an impressive run. For now 2 years, almost 2 full years, the market has been on a week-to-week basis predominantly long instead of short on the Kiwi dollar. And I don't expect that to change anytime soon. Maybe they're all plotting and saying, hey, let's take it up to the all-time highs and then we'll slam it back down. I don't think so. What would you rather be, long Kiwi or long US dollars? I think people don't want to be long more Kiwi than US dollars. There is one other thing that I think is going to continue to benefit the New Zealand dollar, and I think this is going to continue for a long period of time. And this is actually something that I was reading that was a little concerning to me as an individual problem, but also presents possible trading opportunities. They were finding out, there have been studies now, and they've been studying agriculture and particularly food as a whole. And we are coming into a lot of problems in terms of food, in terms of real commodities such as, agricultural commodities, things that are necessary on a daily basis to survive. And a lot of these we are coming into short supply of. We have less and less land that's agrable, and we have an increasing population that's demanding ever more and more food. So those two things are going in opposite direction, and something's going to win out of that. The food supply is so bad that in India, where they grow massive amounts of rice, they're actually paying more per pound of rice than they are in the UK, where they're not growing any rice, really. This is really messed up. They anticipate that this trend will continue minimally till 2030. That agricultural commodities will continue to be in high demand and short supply because the trend is not reversing in terms of increasing population, increasing demand for food and agricultural products, less production of actual food. This leads to a naturally polarized relationship. One of the countries that's going to really benefit from this is New Zealand. Why? Because their commodities that they produce are of the agricultural nature. Not just besides beef, they produce a lot of wheat, they produce a lot of crops. So with that being said, I think they're in a prime position for a very long time to continue to gain as a whole because all of their commodities are getting more and more expensive and are becoming in more and more demand. And I think, and this trend has been going on for a while, it's not something that's just kind of a new thing. This has been going on for a long time. And guess what? Other than the massive sell-off of 2008 that everybody suffered against, for the most part, this thing has really only had two decent pullbacks. One in 2004, one in 2006, minor one in 2007, decent. But that was kind of when the housing and the financial crisis really started to happen. So this series of pullbacks right here we can really attribute to the financial crisis. But other than that, we haven't seen any really strong pullbacks. For the last 10 years, it's been predominantly gaining against the US dollar. And I don't anticipate this trend changing anytime soon. So with that being said, I think the Kiwi dollar is set to continue to make gains. Now, what would be some of these long-term gains that I think it's going to have? Well, based on the most massive sell-off, and then the buy-up, the consequential buy-up here, the market had a very shallow pullback, 38.2. And the shallow nature of that pullback really suggests that the market was kind of eager to be buying New Zealand dollars up. They weren't feeling underconfident about it. They weren't waiting for it to get to a lower price. They were very happy to buy New Zealand dollar on a really good opportunity, and the first one that really presented itself. And that was the 38.2 of that last major move from sub 50 all the way up to 75. 2,600 pip run and the market pulls back just a little bit, and they said, that's enough, we'll take it here, we're going to send it right back up. We make some new highs in this whole process. Well, if this little 38.2 Fibonacci plays itself out, then one of the natural targets will be the 138.2 projection, which is parked right here at 87.09. So I believe that if this trend continues, 85 is an obvious target, but I think 87.09 becomes another obvious target to the upside for this pair. I would not be surprised if it continues to run in that direction there. We also have another move and pullback on this one here, and it went a little bit deeper to the 61.8. The 161.8 projection of that is 88.71. So it's much further than that. However, it should be noted that even though it rejected off the 61.8, it really stopped right here at the 50. It just had one day where it peaked below it, one little week, and then bam, it popped right back up. But it really was held at the 50. Where's the 150 projection of that? Not too far off from where the previous 38.2 projection of this move was. So I suspect that we're going to be seeing Kiwi dollar in the coming months, at least probably between now and before 2011 ends. I think we're going to see it at 87. How long do I think it will take there? Probably till about September, October next year. Maybe even a little bit earlier. It might do it in the summertime. It might just do it this summer. But I think we're going to easily see it make its way up to 87.05. As long as it holds above these all-time highs, I see Kiwi dollar making a nice little run up to 8,700 plus, and maybe even beyond to the 88.71. These are targets that I think it can easily achieve inside of this year, and maybe even inside the next 3 months. Beyond that, it's a little hard to say, but I suspect that the Kiwi dollar will continue to gain as a whole. I think if anybody has a choice between having Kiwis over US dollars, they're going to take Kiwis. And we're just seeing that continue to play itself out in the market. Okay, any questions on that before I move on to here? Yes, no? I'm going to have to teach on Tuesdays more often because you guys on Wednesdays are so quiet. Normally on Tuesdays I got 60, 70 people and they're all asking questions. You guys are much more timid today. That's okay. Okay, Fernando has a question, and before I do that, I want to get to Boyke's question. What times do you enter, etc.? I usually make most of my trading entries when I'm trading off a price action, 4-hour time frames, unless the formation comes on a daily chart. It could be a daily chart formation, and then I'll make it based on that. But for the most part, 4-hour time frames. I rarely, if I was to look at 100 charts, and let's say I was to spend a total of 100 hours surveying charts, 75 to 80+% of that will be on the 4-hour time frame and above. Very rarely will you ever see me dip down below that into the 1-hour time frame. Probably less than 15% of the time. So hopefully that puts that in perspective. It's very easy to get entries on the 4-hour time frame. You don't need to drill down to super small time frames to get an entry. With the right amount of skill, it can be easily done. Fernando, please ask your question, because Harley's beating you to it. Harley says, do you trade the entire 4 hours or longer, or watch a lower time frame after entering? Okay, so I've kind of answered that, but I generally don't watch a lower time frame, especially if I made a trade off a 4-hour time frame. If I made a trade off a 4-hour time frame, then that's really the time compression that I'm looking at to kind of judge the price action. So, more often than not, unless the thing has hit my target, I need to see the next 4-hour candle close before I can have really any additional information. Because until that 4-hour candle closes, it could be anything. It could, become really impulsive. It can become really rejective, corrective. I really need to see that 4-hour candle before I make any decision. And I'm prepared for that ahead of time because chances are I'm not going to get stopped out on the first 4-hour candle that I get into a trade. if I make a trade on a 4-hour time frame, chances are I'm not going to get stopped out on that first 4-hour candle. If I am going to get stopped out, chances are I'm not. So it's not going to be in the first candle. So hopefully that answers your question. Fernando has a question here. You think in terms of price action, understand and see validity on that. On this particular pair, do you continue to give primordial importance to price action over considerations regarding possible rejections or making a prior high? I'll read that again here. Do you continue to give primordial importance to price action over considerations regarding possible rejections of prior major high? Well, isn't that still in the same field? Isn't looking at possible rejections at prior major highs, isn't that also analyzing price action? I'm still analyzing price action. The only difference is when I'm doing that in the past, I'm analyzing historical price action, and then in the present, I'm analyzing live price action. So the difference is the historical price action represents a very specific outcome, order flow environment that created it. It was very specific. It was very unique. The current price action environment is still something that's being formed in real time. It's evolving. It's alive. But it's also the live expression of what is happening in real time. Now, maybe your question is, do I give more weight to the live expression of the market and price action as opposed to historical price action? I don't necessarily have a mantra which says I always give more relevance to the live price action in relationship to historical. However, what I do is I analyze the previous price action, and then I say, okay, what kind of order flow environment would have created that? What was the market response? I look for patterns, and then I kind of just park all that information in my head, which kind of creates a picture, a theme in the market. But then from there, what I do is I look at the live price action, and I say, is the live price action communicating something similar? Is it kind of communicating the precursors of what had created the last environment? If it is not communicating the precursors of the last environment, then I really just look at, okay, what were the levels, and that's all I really need to know about the last environment. At that point, there's nothing else for me to know about the last environment. What I need to know is, okay, this live expression of the market is very different, and what is it communicating to me? Because we already know the critical levels. We don't need to know the price action involved in that because we know that this environment's very different. It's communicating something very different. And we have to be paying attention to it in real time because it's telling us what the next major move is likely to be. So does that answer your question there, Fernando? It's an excellent question. It seems like we had to tease it out a little bit there. But does that answer your question about that? Okay, fantastic. Does everybody else also get that? That this is a critical thing when understanding price action, that we don't always equate live price action, we don't give it the same weight always as historical price action. It's very critical that you understand that. And it's very critical to understand what is the deciding factor, which should tell you you want to be paying more attention to the live price action in relationship to the previous, or you want to be looking at, okay, these two are equal. They're communicating the same thing. And if they're communicating the same thing, then you really need to pay attention to what the previous price action was, because it's giving you hints as to what is the next likely move, which is probably something similar. If it's not, if the current price action is giving you something completely different, then it's very important that you spend more time looking at the most recent price action as an expression of the live market to give you your clues. Very critical you understand that. This is a common mistake or trap that traders fall into. Okay, Harley says, do you walk away from a trade or stay at my computer? Well, most of the time I walk away, but it's not like I push the button and then I just walk away and that's it and I don't look at it again because I'm afraid to micromanage it or anything like that. I can be at my computer and not micromanage a trade. And I don't need to micromanage a trade once I'm in it. All I really, let's say I make a trade, but I'm still at the computer. All I really need to do is I have my stop, I have my limits, I have my targets and everything like that. I accept my stop from the beginning. If it hits the stop, okay, so be it. If it hits my target, so be it. So I'm not really worried if it hits my stop because I've accepted that right off the bat. So there's nothing for me to manage in terms of, maybe getting out of the trade or something like that because I'm worried about it hitting my stop. The only thing I really need to manage is if something unique comes up. All of a sudden, a huge candle comes out of nowhere, something really kind of crazy, kind of an anomaly comes into the market. When that happens, then I need to start looking at managing the position, either for, capturing more profits or, realizing, hey, I need to liquidate this position. I might as well liquidate it now because I'm 110% sure that this is going to result in hitting my stop. Until you're really good at doing that, I would just say let your trade play itself out. Once you put your stop in place, that's it. You've accepted it. You should have gotten to the point where you accept it prior to pushing the button. If you haven't, then you're not ready to take responsibility for that trade and you shouldn't get involved in that trade. Because you will psychologically make decisions that are consistent with not accepting the risk, and therefore you may mess with the trade, which is the worst thing you can do. The only other thing I may need to manage is maybe I have different take profits. Maybe I have one take profit, another take profit. But a lot of that stuff can be easily managed now in platforms. So hopefully answers your question. As long as all those things are still in place, I can walk away, I can have breakfast or whatever. Watch a movie, play a video game or whatever. Whether it's at my computer or not at my computer, I could be reading on my iPad. Hopefully answers your question. Usually, and this is something that's also very important, that question, Harley, that you have, do you walk away from a trade or stay at a computer? That question will go away in time. It will go away in time because you'll have so much experience in the market and you'll have such a consistent kind of experience of trading, or a very predictable experience of trading, that you won't need to really address that question anymore. You may have a style of trading where you do need to, and it's possible you could create that, but that question is something that usually gets resolved over time. It's just part of the process. Anytime I get that question, I usually, can usually tell me at least some point on where the trader is in the process of going through becoming a successful trader. And that's something that I had to address for a long period of time, but it's something that I no longer need to address because I have a relatively predictable experience from trading. I kind of know what to expect out of it. I don't make mistakes that really throw things off. I know how to protect things. I know how to manage risk. I know how to manage these trades. I know how to be consistently accurate, whether it's 60%, 70%, or 80%. I know what that is, and I know what I should be expecting. And as long as I stay within those parameters, there's nothing really else for me to manage. It's just find the opportunity, press the button, and let things take their course. So that question that you had there, Carly, that will go away in time as you continue to gain experience. So, don't worry about that one so much. Eventually you'll answer that for yourself. Sissy Banana says, do you enter trades on a daily 4-hour candle close? Most of the time. 90% of the time I'm entering on candle close. Most of the time. Very rarely will I enter while the candle is still forming. It's one of the worst things you could be doing. Because until that candle closes, it could be in anything. Once it's closed, it has a permanent communication of what it represented for that time period. There's nothing you can do to change that. So hopefully that answers your question. Fernando says, do you keep trades open while sleeping? Absolutely. Fernando, any particular routine on that? In some sense, Fernando, the answer to that question is the same thing with Carly's question, which is, there's only really one slight adjustment that I make, which is, again, for the most part, I have managed my risk right off the bat. I have my stops in place. I have my limits. I have my profit targets, multiple profit targets often. And usually that can all be entered into the platform to be managed. So when I go to sleep, none of that really changes. However, let's say I'm in a position and it's got a ways to go before it hits, say, my final profit target, but maybe I've already hit some profit, and I want to decide how to neutralize the risk. Well, this happened to me yesterday with oil. I was on I wouldn't call it an intraday trade, but it was designed to be done within 24 or 36 hours maximum. And I was in profit, and I said, you know what, I'm going to bed. I want to neutralize some of this risk. So all I did was say, well, how much risk do I want to neutralize? If it turns back, how much profit do I want to walk away from this? And at what point do I feel like it should hold above this, and if it breaks below that, do I want to be out? And that's all I really went through, was that little process. And then I said, okay, I got my levels, put in the level, and that was it, and went to bed. And enjoyed my sleep and didn't think once about my trade. You don't want to be thinking about your trades while you're sleeping. It will totally mess you up over time. I used to have dreams about my trades. I used to actually have dreams about prices, where the prices were in the market in real time. And the scary thing was, I would be like, oh, euro's at this price. And then I would wake myself up and go check, and the euro would be within 3 pips of that price. It was really scary, because what that means is, in some sense, it's a good thing. But in some sense, because it means you're kind of psychologically connected to the market. But in some sense, it's a really bad thing, because you're not walking away from your work, and you're not enjoying sleep for what it's supposed to be. Sleep is supposed to be a time where you rejuvenate, recover, and rest, and process things. It's taking your work to bed, and you don't want to do that. You don't want to take your work to bed. You don't want to take your work in the bathroom or in the shower or anything like that. You want to be able to live a life that you can just enjoy what you're doing when it's not trading. It's the worst thing to do that, and it never gives you any rest. It's one thing if you're really excited about it, you're coming up with a new strategy, and you have this inspiration and creativity that is just dominating, or it's just saturated everything that you're doing. But it's another thing when the market is just following you around, and you can't get away from it to where you can just be in whatever moment that you're doing. It's kind of like, it's just no fun. I mean, what would it be like if you were climbing Mount Everest and all of a sudden you're thinking about currency prices or something like that? You're missing one of the most valuable experiences of your life for currency prices. It's ridiculous. So you want to be able to walk away from the market so that you are fully present doing what you're doing. Because if you're not able to do that, if you can't be fully present with what you're doing when you're away from the market and doing something really simple and easy, then you're never going to be able to be fully present with what you're doing in the moment when you are trading. And that's when you need your focus and attention. It has to be absolutely present. It has to be absolutely there. If you can't be focused when you can't be relaxed in a spa, in some beautiful environment, or in the Patagonia Mountains in Chile, or anything like that, if you can't be relaxed and have your mind free of things when you're at a spa and in an environment like that, and you can't be just present with the moment, then how are you going to ever do it when you have a lot more things to concentrate on and there's a lot more things you need to be processing. It's super critical you learn how to do that. If trading had nothing to do with mind, psychology, and awareness, I would probably be willing to bet 75% of the people would be making money. But unfortunately it does. And it's not unfortunate, because it's actually a really good challenge to actually help you learn things that will be of value to you in the rest of your life. If you can overcome the psychological hurdles and the discipline and the mindset you need to become a successful trader, that will apply to almost everything you do in life. If you can learn to develop the awareness, really focused awareness when you're trading, it will apply to everything you do in life. In fact, a lot of the lessons that I've learned in trading, I actually apply in real life. And they are incredibly valuable. But it's very important. Everybody spends 75 to 85 to 90% of their time working on trading techniques and learning how to read charts and entries and exits and risk management. All these things are critical. They are critical. They are important to learn. But not to the point where you spend 75, 80, 90% of your time learning it. Again, if trading had nothing to do with mind, psychology, and awareness, then that would be a good approach. But it has a lot more to do with that than you could possibly imagine. It has more to do with focused awareness. It has more to do with psychology. It has more to do with mindset. It has more to do with past conditioning about money and finances and your beliefs about that and wealth. And it has more to do with so many things about your mind than you could possibly imagine. And unfortunately, it's the area that traders spend the least amount of time working on. The areas that are actually the most important are the things that traders spend the least amount of time working on. And that's why a majority of traders are not profitable. That's why 75% of traders as a whole are not profitable. Because they're spending 75+% of their efforts focusing on something that doesn't have as much value as they think it does. You know, there was I was watching Braveheart the other day, one of my favorite, it's actually wrong, Swerve Diploma. It's 25% of people are profitable. 90% is an old statistic. But I was watching Braveheart, and it was after William Wallace. He was a young man, and his dad died, and his uncle Argyle was going to take over him. And he's thinking about revenge, and he's thinking about all these things. And he picks up the sword, and he's very attracted to it, and he wants to learn how to use the sword. And his uncle Argyle says something brilliant. He says, "Oh, you want to learn how to use this?" And he says, "First, learn how to use this." And he touches him on his head. And he goes, "Then I will teach you how to use this." And he points to the sword. And if I could train, if I had like this massive school where people could come and everything like that and learn how to become successful traders, I would do the exact same approach. I would teach them how to learn this, learn how to use their mind properly, and then I would teach them how to trade. And I would be willing to bet I could build very highly successful traders. More than 25% of the people out there. I would probably say at least 50+% of the people that came out of that would become successful. Because you have to learn how to use that. So, last question, and then I want to wrap it up. What do you think of when doing yoga? I think about the posture that I'm doing at that point in time. I think about, and it's not really a thinking, and that question that comes in your mind there, Boyke, about what do you think of when you're doing yoga, is kind of, it's also a matter of process. In the very beginning, yoga is really a process of thinking. And then as you become very practiced at it, it becomes a process of feeling. And then as you become really good at it, it becomes a process of just doing. just being. In the beginning, it's just thinking. After that, it becomes more feeling. And then after that, it becomes being. There's no thought. It's just, you just move your body in a particular direction. It just happens like that, and it's effortless. And so, what do I think of when I'm doing yoga? If I'm being really disciplined, I'm not thinking about anything. I'm just doing that posture and just enjoying the expression of that posture. And I'm also very listening to my body and what it's communicating to me at that point in time. So hopefully I answered your question. Okay, these last two, and then that's it. You guys caught me again. Do you hold trades over the weekend? Yes. Do I always make that a standard? No, it's not a standard policy. It depends on the nature of the trade. Sandra Nagira says, do you use London time of year charts? Your first 4-hour candle finish at 4 a.m. GMT? No, actually, mine are set at 1, 5, and 9. So 1 a.m. California time, which is 1 hour after the London Open. So 1 hour after London Open, 5 a.m. and 9 a.m. And I like those the best. My pivots are set to the London Open, but my 4 hours of candles are set to 1 hour after the London Open. And the reason, there are only two types that I would really like. The 12, 4, and 8, which is the London Open, but I prefer the 1, 5, and 9. And the reason why I prefer the 1, 5, and 9 is because of the last two candles, the 5 and 9. If I set my candles, my 4-hour candles, to start at the London Open, then the first 4-hour candles at 4 hours after the London Open has started. And that's kind of like a no man's land. 4 hours, that period right there is a no man's land, because 4 hours after the London Open, there's not that much happening. There's no real new announcements, and it's another hour and a half. It's another hour and a half before an announcement comes out of the U.S., and it's another hour before the American traders start to come on. That's why I like the 1, 5, and 9, because the first 4-hour candle will end at 5 o'clock, right when the American traders are coming in, right where they start to take positions before an announcement comes out. And so I like that one. And it also ends at 9 o'clock very cleanly when the London Open, or when the London session closes. So I like that one the best because of the rhythm it has with the market, whereas the other one is 4, 8, and 12. Well, nothing happens at 4, nothing really happens at 8, and nothing really happens at 12 o'clock either. So, with that being said, and this is California time I'm using here, which is 3 hours behind New York time. So because of that, it's not quite the most natural rhythm to me. But I use the 1, 5, and 9. So hopefully I answers your question. It's actually an excellent question. And so that's pretty much it. Alright, so that's it. I've gone over. And I have something else I have to do before my cleaning lady comes. So I have to bid you all adieu. First off, if you want to check out some more price action articles or some of my current things I'm looking at the market, check out secondskiesforex.com. I have a ton of videos on price action, a ton of articles on price action, a lot of stuff. It's all free. You can read it right there. You can help advance your study of price action there. It's all there. And then if you have any further questions about our courses, such as our advanced price action course, email me, info@secondskies.com. Until then, I want to bid you all adieu. Oh yeah, as Vicky announced, so I'll be back next Tuesday at my regular scheduled time for my price action class. So that will be back on its regular time. But I also want to point out, on next Thursday, I think it is, June 9th, which is the free access day, I'm teaching a webinar on trading Forex and CFDs, which is something that's becoming a continual topic that's coming up. It's becoming very important. And so I'm going to be teaching a class just on that. Click on the link above that Vicky has there to sign up for it. It's a free class. It's a nice 1-hour class that'll be recorded. It's going to be a lot of fun. How to trade spot silver, how to trade spot gold, how to trade oil. All very interesting things to trade. So please come to that class. Until then, I bid you all adieu. I look forward to hearing from you, seeing you on my website. Until then, good luck trading, and I'll see you guys next time. Take care, everyone.